for me to invite him to come and give us his view on the market. Now we trade slightly differently. I'm much more technical, looking at the intricacies of the price as they happen. But now, actually, with a collaboration, I kind of lean a little bit more on Valley's fundamental and sentimental analysis. He's going to give us a steer for the week, and then we kind of look at it, entries using technicals for the actual entries. So would you please put your hands together for my guy, Mr. Valley Patrick?
Hi, thank you so much. Thank you so much. Thank you, appreciate it. Hey, just turn to the person next to you and said, if it wasn't for you, I would be the best looking person in this room. You're not gonna do it. It's your mate. Thank you. Oh, yes. Thank you so much, Leon. Thank you so much. 2 seconds. All right. Are we? Yeah, great. Thank you so much for inviting us down so that we could explore a little into a topic that most retail traders shy away from. I guess they shy away from it for good reason, because it seems complicated, but it's an important aspect that we need to explore if we are traders, right? If you are purchasing oranges, for example, to go and sell on the market, you want to purchase at a good price and sell at a good price. But not only that, you want to know what the market values these oranges at. So if we're trading currencies or trading anything else, we want to have an idea of what the market values these assets at to be able to trade them properly, okay? So a typical retail trader would open the chart. All right, so they will open up they'll open up the chart, right? See the squiggly lines. Sometimes they would put an indicator on the chart, and probably a harmonic scanner, probably a RSI. Back in the olden days, we're in this room above that, but I'm just telling you, right? I'm just telling you their approach. And then they would wait for the RSI to go in an overbought position to look for potential selling opportunities, or oversold position to look for potential buying opportunity. And they're looking at all sorts of things, right, besides price levels, which is what we do a lot for technical analysis. We're looking at price levels. But going deeper than just looking at price levels is understanding the value of the asset that we're trading. Because if the asset is at a certain price, right, would the market think that it is valued in such a way that we want to buy it or we want to sell it? Okay? And this will come from our understanding of what is happening fundamentally or sentimentally in the market. Do we understand that?
Kind of.
Okay. So again, a typical retail trader, they would open up the chart, they look for a signal, right? They look for a signal. Then they would probably look for an entry. Entry. Then they would consider, all right, well, I want to make $100 on this trade, right? Forget about risk management or anything. Like how much I want to make. And then they may win some, they may lose some, and the portfolio is going up and down like this. And they're trying to figure out, what is going on? Why am I not seeing growth in this account? Why am I not? Suppose it probably is my strategy, and then they go change the strategy to something else, buy another indicator, buy another robot, right? We were talking about robots there as a big thing. But that is not how the market works, okay? The reason why an investor would purchase an asset is if they see some sort of value in the asset to purchase, right? So we have to work out what the value of an asset is, but the real hierarchy of trading is we have to understand, number one, what the sentiment of the market is. Okay, is it positive or negative? Okay. Then we need to understand. What is driving the market, and this could be, or what we call fundamentals. Then we need to do our risk management. Then, right here, is where we need to do our technical analysis for entry. Okay? So, people say, oh, you don't do technical analysis. Yeah, I do technical analysis. It's very, very important, but I just don't do it first. Retail traders do technical analysis first and then try to figure things out. Professionals don't do that. Figure out what the sentiment, the technical analysis is last. Okay, we need to flip things around if we're going to see some sort of consistency in trading. Yeah?
Can you just explain for the room the difference between a retail trader and...
Oh, okay, right. Yes, so a retail trader is somebody who could open up their laptop at home, open up a brokerage account at home, and you have full autonomy. You could do whatever you want, right? Institutional trader manages a portfolio of money. They probably have qualifications in trading. They would have licenses to be able to take money from people. And so they manage large amounts of people in a professional setting. So they don't have full autonomy. They just cannot do any and everything with people's money, right? They have to trade under specific guidelines for whatever their institution would have created for them and stick within those parameters to be able to trade, okay? So sentiment, and the reason why sentiment is the most important is because it's how the market, is the mood of the market, is how the market feels about certain events that is happening in the world view. So I'll give you an example. Putin, he decided that he's going to start putting his war tanks on the borders of Ukraine, okay? All of a sudden, he's starting to threaten war in Ukraine. That is going to have an effect on the market, okay? And the effect on the market is, well, let's bring that up. Euro USD. Let's go back to bigger time frame out here. So that happened in, when did Putin invade? February of what year? Last year, isn't it? 2023. Sorry. Okay. So let's zoom in here a little bit. Could I I zoom in, yeah,
22, yeah.
22, right? Yeah. So February 2022, that's Euro USD, right? Yeah, let's go back. There we go, okay. So I think it was around the 20-something, 24th, 25th of February 2022, right here. Okay, so somewhere around here, I think it was the 24th, around here. This is when Putin invaded the Ukraine, and you see the effect on the market, right? The market literally just crashed off, had a big drop, fall. And the reality is that no matter how good the euro economy was doing fundamentally, the sentiment of the market was negative. So because we had a negative sentiment, that took precedent, right? So this is why it's number one in hierarchy. Now, number two, when everything is kind of going all right, then we start looking at what is happening in the economies of the market or different currencies. Now, remember, in currency trading, we're trading one economy against the next. That's essentially what we're doing. We're trading the euro here against the US. So we need to understand what is happening in the euro economy. We need to understand what is happening in the US economy to understand the value, how they value against each other to be able to come up with a good trading opportunity. Yes? No? Make sense? Yeah? So let's look at the different things that actually affect trading economies and what we should really be looking at from a fundamental standpoint. Hopefully, yeah, this will work. There we go. So we have collaborated. Leon and myself, we have collaborated now to have this fundamental group where we put the fundamental, so I do all the fundamental analysis, I stick it in the group here, and we understand what is driving the market. But let's look at this, for example. These are the things that we need to consider, to consider the value of a different currency. So CPI. CPI basically is inflation rate, right? So that's the big talk at the moment. What the inflation rate is like. At the moment, the British pound has the highest inflation rate out of the top 7 economies, right? At the moment, the pound has the highest inflation rate. And all these, the PPI, Producers Price Index, these are all going to affect the value of the currencies. And once we get an understanding of this, we get an understanding of the longer term moves in the market, not short bursts and short moves that people look at from time to time. Right? Big one as well, interest rates. We'll talk about this in a minute. GDP, big one as well. Okay? Retail sales, housing data. And some of these are leading. Some of these are coincidental, right? Some of them are lagging, right? Leading simply meaning this is happening now, and then in the future is going to have an effect on the market. Coincidental meaning it happens now, it's going to have an effect on the market now. Lagging means, well, that's done and gone, right? Done and gone. So let's go to, say, for example, when we started this group, let's go all the way up to the first bit of fundamental analysis that we've ever done on this group, and let's see how that affected the market. So I think we started in July. Let's see if I could get it all the way up. There we go. Right. So the first bit of news that we looked at was actually the GDP news that came out for the German economy. And this was on the 28th of July. Okay? So on the 28th of July, right here on the calendar, we had the German economy, the news came out for that. And when it came out negative. So then I would have spoken with my team and I said, all right, let's do some fundamental analysis on this and see how that is affecting the market. And then we came back with this. So I posted this in the chat. So the GDP contraction in Germany is a negative sign for the German 40. That is what we wanted to trade. We wanted to trade the German 40 index. And we said, all right, so the German stock index, we explained what that is. And he said that the GDP contraction is likely due to these different factors: the war in Ukraine, rising energy prices, supply chain, and all that. And it is likely going to weigh in on the German 40, meaning it's going to be negative, right? So with that understanding, we now understand, all right, well, we've got this news. It's going to be negative for the German economy, for that German 40 index. What are we going to do about it? Then we should be thinking we should probably sell the German 40 index, shouldn't we? With this news, right? Now, when we've done this fundamental analysis, now we decide, all right, so we want to sell this. The probability is in our favor that this German 30 is potentially going to fall because the GDP was negative, right? Negative growth. And so it makes sense that the German economy is going to fall from negative growth, right? Make sense? Mm-hmm. Okay. So then now we do our risk management. We have an account, 100,000. How much do we want to risk on that trade? Right? Usually I would say 1 to 2%. If the probability is heightened, right? And this is the reason why we want to do fundamental analysis, because we get a sense of what the heightened, the probability being a little bit more in our favor, because we have the reason why it should turn around. And we have something called the Kelly criterion. It says in times of heightened probability, you risk more. Okay? You take more risk. So this is now down to you, right? It's up to your risk appetite. It's like, all right, well, I think I could risk 5%, 10% of my account on this trade because the probability is really now in my favor. Okay? But on a normal trading day, you really just want to risk 1 to 2% of your account, to be fair. Okay? But in a situation like this, you probably risk between 5 to 10% of your account on this one trade. So you worked out your risk management. Now, we come to our technical analysis, right? Now, this is where Leon will probably say, right, are we in an impulse? The German 30 is moving up. But now, we've got this negative news. And in fact, let me bring up the chart and bring up that date. Right? So let's go. German 40, but on this chart is German 30. Let's work out the days here. So this was the 20. What date was that? The news was the 28th of July?
Yeah.
Right. Okay, so let's pull this back. So let's put an arrow here. 28th of July. Right? 6 a.m. in the morning. Right here. Okay, so we got the negative news, 28th of July, that potentially we should see a fall in the German 40 index. German 30, same thing. Technical analysis now. Where do we enter? So clearly, the news came out and it didn't drop immediately, right? It didn't drop immediately, but this is where we got our liquidity hunts, right? This is where we got our stop hunts and all of that coming from. So clearly we could see that the market pushed up, stop hunt above that high, stop hunt above there, and then it took 2 days really before it turned around. Okay, so this is where the patience comes in. But you would see some lines on the chart here. This is my technical analysis tool that I've created is called the command contour line. So if I've already established a bias that I want to sell, okay, the question now is when? When do I sell? Okay. If I go down to a lower time frame, you would see things slightly clearer. Right, so there we go. So I have an impulse to the upside. I have a bias to sell. But I'm not ready to sell yet because at the moment, the market is still impulsing upwards. My command contour level is still giving me green signals generally for buy from a technical standpoint. Okay, so I don't necessarily want to do anything here just yet until things turn in my favor and it starts showing me a signal of red to sell. And then is where you get into the market. And then you get the beautiful impulse to the downside, which corresponds with the fundamental of we should be selling this. So it takes a little bit of patience, takes a bit of seeing things on a bigger perspective, rather than just looking at 1 hour time frames or 2 hour time frames or 4 hour time frames or whatever. But you could see here, since that news, the German 30 has not recovered. It's dropped off like crazy, right? And that is kind of still driving the sentiment of the market at the moment. Understood?
Yep.
Understand? Let's look at gold. Recently, right? Recently we took a position on gold here. Right, this one. Right? This one is what we spoke about in the chat recently. So, kind of similar situation where the market is trending up, just that we had a reaction right at this candle here, which was the news that affected that was the non-farm payroll news. Okay? That's right. On the 1st of September, if we scroll all the way down, sorry, if I go all the way down, so let's see where that was. 1st of September. There we go. This is where we were talking about it. Yeah. Right here. Okay. So we say, based on the fundamentals, the non-farm payroll should be positive. And then I posted this chart. Right? Right there. So what does that mean? What is the non-farm payroll? So the non-farm payroll really is employment in the U.S. So the employment figures in the U.S. came in positive for the U.S. Remember, we're trading, for this instance, we're trading one currency against the next. In this instance, is a commodity against a currency, gold against the U.S. The U.S. got stronger, right? The U.S. got stronger than this gold USD because we have, there's a specific spelling here, right? We have the base currency and we have the quote currency. So which one is in front of the other? So if the quote currency is stronger, then it's going to fall. If the base currency is stronger, it's going to push up. Okay? So we have to always remember that as well so that we're trading in the right direction. Okay? So in this instance, the US has gotten stronger, but for some reason, again, from a technical analysis standpoint, okay, so fundamentally, we knew that we want to sell, but from a technical standpoint, which is technical analysis still important, we got that stop hunt, liquidity run, right? Take out all the weak hands, and then all of a sudden it starts dropping off. And that thing dropped off for over, right? That's over 300 pips. It dropped off. Just based on that fundamental data. Yeah? Yeah, just based on that fundamental data. So you're seeing the importance of having that fundamental data with you, so that you could establish that bias, get that bias into your head, and then we decide how much risk we want to put on that trade, and then we decide how we want to enter based on technical analysis. So that's the real hierarchy. Now sometimes the fundamental data will come out, and it doesn't necessarily go in your favor just yet, right? So you may have a losing scale. Like for example, this week I sent on Friday actually. I sent this out. So we had some news on Japan, right? The GDP, it grew, right? So we're expecting that the Japan economy is going to do a bit better. The GDP got stronger. It's a positive sign for the Japanese economy, right? There are still certain areas of concern. So sometimes it's not clear cut. So based on that information, I was saying, all right, well, potentially we should sell the USD JPY, right? But it didn't sell, right? It just didn't sell, at least not at that time right now. It hit the stop loss, right? And that's trading for you. So this is why we need to manage our risks appropriately. So if I bring up this chart, USD JPY. Right, so there we go, right? So we stop loss hit. However, we still, on the back of our minds, we still know that we do have some positive news for the Japanese yen. So we still keep an eye on this for potential entry. So the impulse at the moment is an upside. All I'm just going to do is wait. I'm just going to wait for this tool to turn red for me, and then I'll potentially take a sell. But not just yet, because I still need to understand what's happening in the US economy as well, right? We're still running off of good data on the US economy as well. So we just got to be patient and, play our cards look at different economies, look at different things that's happening, probably in, say, for example, in the GBP economy, for example. GBP had some negative news recently, and we caught this sell beautifully, right, to the downside because of that negative news. And then plus, remember, the US had strong news, right? So when we're trading, we want to trade something that has negative news or a negative sentiment towards it against something that has positive sentiment towards it. And that will give you your best trading opportunities. Any questions?
Mine is more on the command contour.
All right, okay, yeah.
You know we got that coming up, right?
Yeah, sure. So the command contour is just a tool that marks off significant and key price levels to enter the market at. I wish this line down here didn't exist, but for some reason, on TradingView, this line exists. I do have it on MetaTrader 5 where this line doesn't exist because it kind of adds added complexity that is not necessary. What we want are these horizontal lines right here, right? These horizontal lines. So these horizontal lines, generally, if the market is trending in a downward way, or trending downwards, it will be red, okay? It will be all colored red. If the market is trending, having a trend upward, it will be colored green. But for all intents and purposes, what we use them for is just an area or a line to get into the market at